Welcome to this explainer. Okay, today we're going to play detective and follow the high-stakes journey of an approved invoice as it navigates the final security checkpoints before hard cash actually leaves your business. We spend so much time talking about approving invoices, but the truth is, once that three-way match is confirmed between the purchase order, the receipt, and the invoice, that's when the real action begins. You've got an approved piece of paper, sure, but how does that translate into a cleared supplier payment without exposing your company to massive risk or draining your cash reserves at the absolute wrong time? Well, that's exactly what we're going to unpack today.
Here is our roadmap for today. We'll be covering 1. The payment pipeline. 2. Timing is everything. 3. The security checkpoint. 4. Balancing the books. And finally, 5. Measuring AP success. Let's dive right in.
Part 1. The payment pipeline. We're kicking things off with Stage 07 in the wider Procure-to-Pay cycle, where a simple piece of paper officially enters the payment pipeline and gets its permanent financial identity.
Before an invoice is posted, it has to be coded accurately. Think of this as giving the expense its very own DNA. We map it to a general ledger account, which basically tells us the nature of the expenditure. Is this inventory, an operating expense, maybe a fixed asset? Then we assign it to a cost center, which identifies the specific business unit or department responsible for the spend. And finally, if it applies, it gets tied to a specific project code. This coding is absolutely foundational. In fact, invoices above certain thresholds even require additional management approval before they can officially enter the payment queue.
Now here's the kicker. That invoice coding, it determines exactly how a cost shows up in literally every single financial report down the line. If you make an error here, you're not just giving accounts payable a headache, you're actively distorting your income statements. You're corrupting your cost center reports, and you're throwing your project budgets completely out of whack. A mistake at this stage corrupts your entire profit picture. It is that serious.
Moving right along to Section 2, timing is everything. Let's look at Stage 08, which is payment scheduling.
This is where we step away from pure accounting and start playing a highly strategic game. Exactly when do we release the cash? Approved invoices are scheduled for payment based on a really careful balancing act of 3 critical inputs. First up, due dates. You absolutely must avoid late payment penalties and protect your supplier terms. Second, early payment discounts. This is a direct cash benefit, but you got to evaluate if that discount is actually worth the cost of paying early. And third, your overall cash flow position. You want to avoid massive cash outflows hitting exactly when you have other financial demands. All of this comes together to form a carefully planned payment run.
Section 3, the security checkpoint. All right, the payment run is prepped. Now it hits Stage 09, payment execution. You can think of this as the ultimate high-stakes security checkpoint. And here, the absolute core control comes down to just one single number. 2, as in dual authorization. It takes a minimum of 2 authorized signatories to approve a payment run above defined thresholds. This is completely non-negotiable. It ensures that no single person in your organization can unilaterally move significant amounts of cash. Plus, we have segregation of duties. You can think of this exactly like needing 2 separate keys to launch a missile. The person who initiated the transfer, they must be completely separated from the approval process. If you initiated the payment, you cannot be the same person who approved the invoice, and you definitely cannot be the person who approved and set up the vendor in the system in the first place. This structural separation is literally your primary defense against internal fraud. Now, when you're reviewing a payment run, it has to be an active, investigative check, not just some blind sign-off. You've got to hunt for red flags. Are we paying recently added vendors? That's a huge risk. You must verify their legitimacy independently. How about ad hoc runs outside the normal payment cycle, especially to unfamiliar vendors? That right there is one of the absolute highest risk fraud patterns in the entire procure-to-pay cycle. Also, keep an eye out for round number payments or amounts that are just significantly larger than prior periods. Never, ever authorize these without getting a solid explanation first. Part 4. Balancing the books. Okay, so the cash has successfully and safely left the building. Now we hit stages 10 and 11 to deal with the aftermath of accounting entries and officially close the period.
There are 2 key economic events that have to be recorded in the right accounting period. First, when that invoice arrives, the liability is recorded. You debit your expense or inventory, and you credit accounts payable. Second, when the payment executes, the liability is cleared. You debit accounts payable, and you credit your cash or bank account. It is incredibly vital that these entries are posted based on when the economic event actually happened, not just the random date someone decided to finally process the paperwork.
And this brings us to a massively important concept. Seriously, this is a cardinal rule in accounts payable: period end accruals. If you have a goods receipt note, meaning you actually received the goods or services, but hey, no matching invoice has shown up by the period close date, you absolutely must accrue that expense. If you skip this step, your expenses are understated, and you are artificially inflating your profits. You're basically painting a completely false picture of your business's health.
To close out the period cleanly, you have to nail 3 vital reconciliations. First, your AP subledger has to perfectly agree with the general ledger. Second, your internal AP records need to be checked against external supplier statements. That's how you catch missing invoices or misapplied payments. And finally, every single payment you made must be confirmed against the bank statement. Look, supplier statement reconciliation isn't just optional busywork. It's the ultimate external reality check on your own internal records.
Which brings us to Section 5, Measuring AP Success. We've done all this work, but how do we actually know if we're doing a good job?
Well, your AP aging distribution breaks down your outstanding payments. A healthy AP department is going to have a distribution that's mostly current, with very little aging beyond 60 days. But if you start seeing those 60 or 90-plus day buckets growing, those are glaring warning signs. It means invoices are stuck in dispute, trapped in approval queues, or just missed entirely. If your suppliers are complaining, that's a lag indicator. This distribution would have warned you that the problem was brewing weeks ago.
We also look closely at Days Payable Outstanding, or DPO. This measures the average number of days it takes to pay after an invoice date. It's a real strategic balancing act. A high DPO? Well, that means you're holding on to cash longer, which boosts your liquidity, but you're risking breach terms and late penalties. A low DPO means you're paying quickly. That wonderfully protects those vital supplier relationships, but it definitely reduces your available working capital. Also, fair warning, if your DPO is trending up and you don't have a deliberate strategic reason for it, it probably just means you have a massive AP processing backlog, not some clever cash management strategy.
So, now that you've got a grip on the mechanics, everything from coding DNA and dual authorization right through to accruals and DPO, I want you to ask yourself this final question. Is your accounts payable process just administrative bill paying, or are you actively managing the pay side to optimize your cash, capture those discounts, and protect the financial lifeblood of your business? The difference between those two approaches is exactly what separates a surviving business from a thriving one. Thanks for joining me on this explainer, and keep asking the right questions.